When oil suddenly spikes above $100 a barrel, the story is not just about energy. Oil sits at the center of the global economy in a way that no other commodity does. It affects what you pay at the pump, what manufacturers pay to produce goods, what shipping companies charge to move those goods, what farmers pay to grow food, and ultimately what central banks have to do with interest rates to keep inflation under control. When oil prices spike sharply and suddenly, every one of those channels activates at the same time. And the financial markets that are watching all of this in real time, equities, bonds, currencies, and yes, crypto, all begin repricing the new reality simultaneously. We just watched crude oil spike to $115 a barrel, one of the sharpest moves in years, before pulling back to around $92 after the G7 announced a coordinated release of emergency oil reserves. Most people looked at the pullback and thought the crisis was over. It is not. What just happened is a warning signal about how fragile the global economic system is when a single commodity in a single region experiences a supply shock. And understanding why that warning signal matters is what this video is about. Let us start with what actually happened in the oil market, because the sequence of events matters for understanding what comes next. Oil prices spiked sharply to $115 per barrel following a supply disruption that removed a significant volume of production from global markets. To put that in context, the disruption associated with this event was larger in terms of daily barrel loss than the Russian production disruptions that markets had to absorb in 2022. The oil market operates on relatively thin inventory buffers under normal conditions. When a large supply disruption hits, the market does not gradually reprice. It reprices immediately and sometimes violently because traders are not just responding to the physical supply shortfall today. They are responding to their uncertainty about how long the shortfall will last and whether it will get worse before it gets better. The G7 response, coordinating the release of approximately 400 million barrels from emergency strategic reserves across member nations, was designed to send a signal to the market that major governments were willing to use their buffer stocks to cap the price spike. It worked, at least temporarily. Oil fell back to around $92. But here is the critical piece of context that most coverage missed entirely. The total strategic petroleum reserves held globally are approximately 1.2 billion barrels. 400 million barrels represents a third of that total buffer. And 400 million barrels, at current global consumption rates, covers roughly 3 weeks of the disrupted supply. If the underlying supply problem persists beyond those 3 weeks, the buffer is gone and the market has to price the shortage on its own terms. The G7 reserve release bought time. It did not solve the problem. And the difference between buying time and solving the problem is exactly what markets are trying to price right now. Now let us trace exactly how an oil shock of this magnitude moves through the broader economy, because this is where the story gets significantly more complex than most financial coverage suggests. The first and most immediate channel is transportation fuel. Gasoline and diesel prices respond to crude oil prices with a lag of days to a few weeks, as refiners adjust their purchase costs and wholesale prices move through to retail stations. In the United States, gasoline prices had already risen sharply over a 4-month period, and diesel prices in Europe had roughly doubled from recent baseline levels. For consumers, this is the most viscerally felt dimension of an oil shock, and it has a direct mechanical effect on household finances. Every additional dollar per gallon at the pump is a dollar that is not available for spending on other goods and services. That reduction in consumer purchasing power flows through to retail sales, restaurant spending, entertainment, and discretionary consumption broadly. The second channel operates through manufacturing and industrial input costs. Oil is not just a transportation fuel. It is the feedstock for an enormous range of industrial chemicals, plastics, synthetic rubber, adhesives, lubricants, and thousands of other materials that are inputs to virtually every category of manufactured goods. When crude oil prices rise, the cost of these petrochemical derivatives rises with them. That cost increase moves through supply chains with a lag of several months, eventually showing up in the prices of consumer goods, industrial equipment, automotive components, and construction materials. The third channel is agricultural. Diesel powers the machinery that plants and harvests crops. Natural gas is the primary input for nitrogen fertilizer production and natural gas prices tend to move with oil prices during supply disruptions. When farm input costs rise, farmers face a choice between absorbing the margin compression or raising prices on the food they sell. Food price inflation is particularly consequential because food spending is the most inelastic category in household budgets. People can delay buying a new phone or skip a vacation. They cannot stop eating. The Asian economic picture deserves specific attention because the data shows that oil-importing Asian economies are among the most vulnerable to this type of supply shock, and the financial market reaction in Asia was both fast and severe. Regional equity markets sold off sharply, with the MSCI Asia-Pacific Index recording one of its largest single-week declines in years. Capital flows data showed approximately $11 billion exiting emerging market equity funds in Asia outside of China in a compressed time frame, which is a historically significant outflow reflecting institutional investors reducing exposure to vulnerable economies. The vulnerability is structural. Most major Asian economies import the overwhelming majority of their oil and gas requirements. They do not have large domestic production bases to cushion the impact of global price spikes. When oil prices rise sharply, their trade balances deteriorate, their currencies come under pressure, their inflation rates rise faster than in economies with domestic energy production, and their central banks face pressure to raise interest rates even if their domestic economic conditions do not warrant it. The country-level growth impact data is striking. Singapore and Taiwan, two of the most trade-dependent and energy-intensive economies in Asia, face the largest proportional hits to real GDP growth from an oil price shock of this magnitude. South Korea and Hong Kong face significant but somewhat smaller impacts. India, the Philippines, Malaysia, Thailand, and Indonesia face meaningful hits to growth, though their larger domestic demand bases provide somewhat more cushion. China faces the smallest proportional impact among major Asian economies, partly because its energy sourcing is more diversified geographically and partly because state control over energy pricing allows for some domestic insulation from international price swings. The South Korean equity market reaction was particularly notable, with major semiconductor companies experiencing some of their largest single-session declines in decades, reflecting the direct connection between energy costs and chip manufacturing economics. Here is where the story gets particularly uncomfortable for anyone hoping that central banks can smooth this over quickly. The inflation mathematics of a sustained oil shock in the current environment are genuinely difficult. Headline inflation had been coming down from its post-pandemic peaks in most major economies. Central banks in the US, Europe, and several Asian economies had either already begun cutting interest rates or were positioned to do so in the near term. Those rate cuts were predicated on the expectation that inflation would continue declining toward target levels. An oil shock of this magnitude breaks that assumption. The transmission from higher oil prices to measured consumer price indices takes between 3 and 6 months to fully materialize, because it has to work its way through production costs, transportation costs, and retail pricing before it shows up in the official inflation statistics. That means even if oil prices stabilize at current levels tomorrow, the inflation impact of the spike is still coming through the pipeline for the next several months. And central banks know this. The Federal Reserve, the European Central Bank, and the Bank of Japan are all looking at the same math and reaching the same uncomfortable conclusion. The rate cut cycle that markets have been pricing is likely to be delayed, possibly significantly. That repricing of the interest rate outlook is itself a major source of financial market volatility, independent of the direct economic impact of the oil price shock. Equity valuations are sensitive to interest rate expectations because future earnings are discounted at the prevailing interest rate. When rate cut expectations are pushed out, valuations contract. Bond prices fall as yields rise to reflect the reduced probability of near-term rate cuts. Currency markets adjust as interest rate differentials between countries shift. The financial market impact of an oil shock is not just about energy sector economics. It is about the entire repricing of the risk-free rate that underpins all asset valuations. Let us talk about what Dubai and the Gulf more broadly represents in this picture, because there is a counterintuitive dynamic at play that is worth understanding. Dubai has positioned itself over the past 2 decades as a global financial center, a tourism destination, a real estate investment market, and a logistics hub. It is deeply integrated into global capital flows in ways that are quite different from the traditional Gulf oil economy model. When global financial markets experience stress, Dubai does not benefit from higher oil prices the way a pure oil exporter might. It feels the negative effects of global financial market volatility through reduced tourist arrivals, slower real estate transaction volumes, and reduced appetite for the regional financial services it provides. The Dubai equity market saw sharp declines in the period under discussion, with significant losses in a compressed trading timeframe. Real estate transaction data showed cooling at the margin. These dynamics reflect the fact that in a globally integrated financial center, the negative wealth effects of market volatility can dominate the positive terms of trade effects of higher oil prices in the short run. The longer-term picture for Gulf economies depends on how long elevated oil prices persist and how successfully they can continue attracting the global capital and talent flows that have been driving their diversification strategies. For now, the market reaction reflects genuine uncertainty about both of those questions. Let us bring this back to what it means specifically for digital asset markets and crypto, because this is a question that anyone following the space is asking. Crypto markets have evolved significantly in terms of their correlation with broader financial markets over the past several years. The narrative of crypto as a pure inflation hedge or as an uncorrelated asset class has been complicated by the observed behavior of digital assets during periods of macro stress. What we actually see consistently is that when global risk appetite contracts sharply, as it does during a significant macro shock like an oil supply disruption, institutional investors who hold crypto as part of a broader risk asset portfolio reduce their exposure across all risk assets simultaneously. This is not a reflection of any fundamental problem with blockchain technology or any specific crypto project. It is a reflection of portfolio construction and liquidity management dynamics. When an institutional investor needs to raise cash or reduce risk exposure, they sell what they can sell, and liquid assets like large-cap crypto tend to be sold alongside equities and other risk assets. The recovery path for crypto after a macro shock depends heavily on how the macro shock resolves. If the oil price spike is temporary and inflation expectations stabilize, the conditions that have driven institutional interest in digital assets remain intact. If the oil shock is sustained and triggers a genuine inflationary spiral that forces central banks into a prolonged period of high interest rates, the environment for risk assets broadly becomes more challenging. The honest answer is that nobody knows yet which scenario is playing out. What we do know is that the macro environment has shifted in ways that create genuine uncertainty, and markets are repricing that uncertainty in real time across every asset class. Here is the full picture and what it tells you about how to think about periods like this one. The oil price spike and the subsequent partial recovery following the G7 reserve release is a specific event within a larger structural story about global energy supply vulnerability, geopolitical risk, and the limits of the buffers that the global economy has available to absorb supply shocks. The reserve release was a rational and appropriate policy response. It did what it was designed to do. But 400 million barrels covering 3 weeks of disrupted supply is a finite tool being used to manage an uncertainty with an open-ended time frame. The economic channels through which this shock propagates are all active simultaneously. They play out on different timescales. The pump price impact was immediate. The manufacturing cost impact will take months. The inflation data impact will take a quarter or two. The central bank policy response to that inflation data will take longer still. Understanding this sequence of transmission mechanisms is more useful than trying to forecast exactly where oil prices will be in 60 days, because the sequence tells you which economic and financial variables to watch and what to expect from them as the situation evolves. The investors who navigate macro disruptions most effectively are not the ones who react fastest to headlines. They are the ones who understand the system well enough to know which signals matter and which ones are noise. That kind of systemic understanding is what separates reactive trading from informed long-term positioning. This video is for educational purposes only and does not constitute financial advice. Nothing discussed here should be interpreted as a recommendation to buy, sell, or hold any financial asset. Always conduct your own research and consult a qualified financial professional before making any investment decisions.